Your bank just paid 340% more to protect itself than it did 6 months ago. Not to protect you, to protect its own balance sheet. The cost for a major U.S. financial institution to hedge against another bank failing has surged from 22 basis points in July 2025 to 97 basis points as of January 21, 2026. That represents the steepest 6-month climb in bank credit default swap pricing since March 2023, when Silicon Valley Bank and Signature Bank collapsed within 72 hours. This is not a stress test. This is not a regulatory drill. This is actual capital being deployed by institutions that cannot afford to be wrong about systemic stability. The interbank lending market, the circulatory system of modern finance, is now pricing in risk levels not seen outside of acute banking crises. The repricing has already occurred. The hedges have already been placed. The institutions with the most to lose have already acted. The question is not whether banks see something you don't. The question is what happens when the cost of trusting other banks becomes more expensive than the business of banking itself. I'm John A.G., and this is the Collapse Files. Between July 15, 2025 and January 24, 2026, credit default swaps on the market iTraxx Europe Senior Financials Index, which tracks the cost of insuring debt issued by 25 of Europe's largest banks, rose from 58 basis points to 112 basis points. Simultaneously, the market CDX North America Financials Index covering major U.S. banks moved from 47 basis points to 89 basis points over the same period. These are not abstract indicators. These are real premiums paid by real institutions to transfer the risk of bank failure to counterparties willing to assume it. The move accelerated dramatically in the final 6 weeks. On December 9, 2025, U.S. Bank CDS spreads traded at 61 basis points. By January 24, they had reached 89 basis points, a 46% increase in 43 days. The European index moved even faster, rising from 74 basis points to 112 basis points over the same period, a 51% surge. These are velocity metrics associated with crisis formation, not gradual drift. Breaking this down by institution reveals the concentration of stress. Credit default swaps on Deutsche Bank 5-year senior debt rose from 86 basis points in mid-November to 147 basis points by mid-January, a 71% increase in 8 weeks. Societe Generale moved from 72 basis points to 119 basis points over the same window, a 65% increase. In the United States, Bank of America CDS spreads widened from 52 basis points to 81 basis points between December 1st and January 20th, while Citigroup moved from 64 basis points to 98 basis points. What makes this abnormal is not merely the direction, spreads widen periodically during market volatility, but the decoupling from equity performance. Major bank stock indices in both the US and Europe declined only 6.8% during the same period when CDS spreads surged 40-50%. Historically, credit and equity markets move in tandem. When they diverge, it indicates that debt investors, who get paid first in a bankruptcy, are pricing in risks that equity investors either do not see or are choosing to ignore. The divergence is compounded by what is not happening. There's been no major loan default, no regulatory announcement of capital shortfalls, no geopolitical shock specific to banking. Earnings reports from major institutions in late 2025 showed net interest margins stable and loan loss provisions within normal ranges. Economic growth in the U.S. remained positive at 2.1% in Q4 2025, and European growth, while weak, was not recessionary. The move is occurring in the absence of visible catalyst, which means the market is responding to information asymmetry. Participants in the bank CDS market include other banks, insurance companies, hedge funds, and sovereign wealth funds, institutions with balance sheets measured in hundreds of billions, with risk departments staffed by hundreds of analysts, and with access to proprietary data on interbank exposures, derivative books, and asset quality that will not be disclosed publicly until quarterly filings months from now. When these participants simultaneously increase the price they are willing to pay to hedge bank counterparty risk, it is not speculation. It is preemptive action based on visibility into stress points the public cannot yet see. The chart forced their hand. The hedging is complete. The signal is live. The interbank lending system is designed to allow financial institutions to borrow from and lend to each other on a short-term basis to manage liquidity, meet reserve requirements, and facilitate payment settlement. A bank that experiences temporary deposit outflows can borrow overnight, or for a few days from a bank with excess reserves. The system depends entirely on mutual trust. If Bank A believes Bank B might fail, Bank A will not lend to Bank B, regardless of the interest rate offered. Credit default swaps on bank debt exist precisely because this trust is never absolute. A bank that holds another bank's bonds, or has derivative exposure to that bank, or relies on that bank for settlement services, can purchase CDS protection to hedge the risk of default. The premium paid for this protection, the CDS spread, reflects the market's real-time assessment of that bank's creditworthiness. When spreads are low, confidence is high. When spreads widen rapidly, confidence is eroding. The system functions smoothly when capital is abundant. Asset valuations are stable and central banks provide a credible backstop. Under these conditions, banks lend to each other freely, CDS spreads remain compressed, and liquidity flows efficiently through the financial system. But the system has embedded fragility. Banks are leveraged institutions, typically operating with equity representing 8 to 12% of total assets. A 10% decline in asset values can wipe out most or all of a bank's equity cushion. And because banks are interconnected through lending, derivatives, and payment systems, distress at one institution can propagate rapidly. This is where the hedging becomes self-reinforcing. When Bank A sees Bank B's CDS spreads widening, it responds by reducing exposure, pulling credit lines, demanding more collateral on derivatives, or refusing to roll short-term funding. These actions validate the original spread widening because they reduce Bank B's liquidity and increase its funding costs. Bank B then faces a choice: sell assets to raise cash or borrow from the central bank. Selling assets in a stressed market depresses prices further, which increases losses across the entire sector. Borrowing from the central bank signals distress, which widens spreads even more. The trapped participants are institutions that cannot reduce exposure quickly. A pension fund holding $5 billion in bank bonds cannot liquidate without triggering significant market impact and realizing losses that impair its ability to meet future liabilities. An insurance company with $20 billion in derivative exposure to major banks cannot simply walk away. The contracts are legally binding, and unwinding them would require posting collateral the company may not have. A smaller regional bank that relies on funding from larger banks cannot diversify its counterparty risk when all major banks are simultaneously widening spreads. These institutions are forced to hedge at elevated prices or accept unhedged exposure to systemic risk. Both choices are costly. Hedging at 89 basis points, when the historical average is 35 basis points, means paying 2.5 times normal cost for protection. Not hedging means accepting the risk that a $1 billion exposure to a failing bank becomes a total loss. For institutions managing other people's money, pension funds, insurance companies, mutual funds, the fiduciary obligation to hedge is non-negotiable regardless of cost. The system is designed to distribute risk. It is failing because risk is now concentrating among those least able to bear it, at prices that make hedging prohibitively expensive for those most required to do it. This is the mechanical precursor to system-wide deleveraging. The chart didn't cause the failure. The chart revealed that the failure was already in motion. The 89 basis point level on U.S. Bank CDS spreads represents the highest reading since May 2023, immediately following the regional banking crisis. At that time, spreads peaked at 102 basis points on March 15, 2023, the day after Silicon Valley Bank was seized by regulators. Within 6 weeks, emergency Federal Reserve lending programs injected $400 billion in liquidity, and spreads retreated to 58 basis points by May. The current move to 89 basis points has occurred without any such intervention and without any public acknowledgement of stress. The spread between bank CDS and non-financial investment grade corporate CDS has widened to 32 basis points as of January 21, 2026. This financial spread measures the additional cost to insure bank debt versus corporate debt of similar credit rating. During stable periods from 2017 to 2019, this spread averaged 8 basis points. During the 2020 pandemic crisis, it peaked at 78 basis points before central bank intervention. The current 32 basis point spread is not yet at crisis levels, but the velocity of widening matches the early stages of previous crises. Analyzing the term structure reveals further stress. 1-year CDS protection on major U.S. banks now costs an average of 73 basis points, while 5-year protection costs 89 basis points. This upward sloping curve is normal. Longer-term protection should cost more due to greater uncertainty. However, the slope has steepened dramatically. In July 2025, the difference between 1-year and 5-year protection was 9 basis points. Today it is 16 basis points, a 78% increase in term premium. This indicates the market is pricing an elevated near-term risk that, if survived, may subside, or it reflects uncertainty about how long current stresses will persist. Trading volume in bank CDS has surged in parallel with spreads. Average daily notional value traded in North American financials, CDS, exceeded $8.2 billion in the first 3 weeks of January, compared to a 2025 average of $3.1 billion. This represents a 165% increase in trading activity, indicating active repositioning by large institutions. This is not speculative trading. The bank CDS market is dominated by hedgers, institutions with actual exposure seeking to transfer risk, not by directional traders. The correlation between bank CDS spreads and equity volatility is broken down. The VIX index, measuring expected stock market volatility, averaged 17.3 in January 2026, elevated but not extreme. During periods when bank CDS traded at current levels historically, the VIX averaged 32. This 46% divergence suggests credit markets are pricing in bank-specific stress that has not yet transmitted to broader equity markets. Historically, credit leads equity by 4 to 12 weeks during crisis formation. Examining cross-border dynamics, European bank CDS spreads are widening faster than U.S. spreads. The ratio of European to U.S. bank CDS has risen from 1.23 in July 2025 to 1.6 in January 2026. While this seems like a small move, it represents a significant shift in relative risk perception. European banks carry higher exposure to commercial real estate in declining markets, sovereign debt from fiscally stressed nations, and complex derivative books with opaque counterparty risk. The faster widening in European spreads suggests these exposures are being repriced aggressively. The basis, the difference between CDS spreads and cash bond spreads, has also moved into negative territory for several major banks. When CDS protection is cheaper than the yield premium on a bank's bonds, it creates an arbitrage opportunity. Buy the bond, buy CDS protection, and lock in a risk-free profit. The fact that this basis has gone negative indicates forced selling in cash bond markets or overwhelming demand for CDS protection that has pushed spreads beyond fair value relative to bonds. Either explanation points to market dysfunction. Finally, the ratio of bank CDS to sovereign CDS has inverted in several cases. Deutsche Bank's 5-year CDS at 147 basis points now trades 39 basis points wider than German sovereign CDS at 108 basis points. This means the market perceives more risk in lending to Germany's largest bank than in lending to the German government itself. Historically, banks trade tighter than their home country sovereign because of implicit government support. Inversion indicates the market believes that support is either unavailable or insufficient. The first critical precedent is the summer of 2007, when bank CDS spreads began widening in advance of the broader financial crisis. In June 2007, Bear Stearns disclosed that 2 of its hedge funds heavily invested in subprime mortgage securities were facing massive losses. Bank CDS spreads, which had traded in a stable range of 15-20 basis points for the prior 2 years, began moving higher. By August 2007, spreads on major U.S. banks had reached 45 basis points, a 150% increase in 8 weeks. Critically, equity markets were not yet pricing in systemic risk. The S&P 500 reached an all-time high on October 9, 2007. Major bank stocks were down only modestly from their peaks. Earnings reports remained strong. Regulators insisted the subprime crisis was contained. But the CDS market was pricing in a different reality. Institutions with access to mortgage performance data, exposure reports, and interbank funding flows knew that losses were accelerating and that trust within the banking system was eroding. By March 2008, Bear Stearns failed and was sold to J.P. Morgan in a government-facilitated rescue. Bank CDS spreads reached 110 basis points. By September 2008, when Lehman Brothers filed for bankruptcy and AIG required a government bailout, bank CDS spreads spiked to 245 basis points. The institutions that had hedged in mid-2007, when spreads first started widening, protected themselves against losses that would eventually total trillions of dollars. Those who waited for confirmation in equity markets or regulatory disclosures found protection unaffordable or unavailable. The outcome? The U.S. government committed $700 billion through TARP. The Federal Reserve expanded its balance sheet by $1.3 trillion in emergency lending, and the economy entered the deepest recession since the 1930s. The signal was visible 14 months before the crisis peak in the bank CDS market to anyone who was watching. The second precedent is March 2023, when Silicon Valley Bank collapsed. In the weeks leading up to the failure, SVB's CDS spreads had widened from 32 basis points in early February to 89 basis points by March 8th. The bank's stock price had declined only 15% over the same period. Depositors, reassured by equity market calm and management statements, left their funds in place. But the CDS market knew the bank was insolvent. Its bond portfolio, loaded with long-duration treasuries purchased at low yields, had lost 20% of its value as interest rates rose. The bank did not have enough capital to absorb these losses. On March 9th, SVB announced it was raising capital to cover losses from selling securities. The announcement triggered a bank run. Within 48 hours, depositors attempted to withdraw $42 billion, a quarter of the bank's total deposits. Regulators seized the bank on March 10th. Signature Bank failed 2 days later. Within a week, Credit Suisse required emergency merger with UBS to avoid collapse. Bank CDS spreads across the U.S. and Europe surged to levels not seen since 2008. The Federal Reserve responded by creating the Bank Term Funding Program, offering $25 billion in emergency lending to stabilize the sector. Spreads peaked at 102 basis points on March 15th and then retreated as liquidity was injected. But the institutions that had hedged in early March, when spreads first crossed 70 basis points, protected themselves against losses that occurred in days, not months. The pattern across both precedents is identical. Credit markets reprice risk based on information asymmetry, equity markets lag by weeks or months, public acknowledgement comes only after failure is imminent, and those who act on credit, signals rather than waiting for confirmation, are positioned to survive. The current move in bank CDS follows this exact template. Spreads are widening rapidly in the absence of public catalyst, indicating institutions with access to proprietary risk data are hedging preemptively. The mainstream financial narrative remains focused on inflation data, central bank policy statements, and equity market performance. These are lagging indicators that confirm what has already occurred. The bank CDS market is a leading indicator that prices and what institutions with asymmetric information believe is about to occur. The divergence between these two realities creates an information gap that sophisticated participants exploit and retail participants suffer. What most people miss is the role of derivative exposure in amplifying bank fragility. Major global banks hold derivative positions with notional values exceeding $200 trillion, while the actual at-risk exposure is far smaller due to netting and collateral. Even a 1% loss on gross notional would represent $2 trillion in capital destruction. These positions are heavily concentrated among the largest institutions, creating a web of interdependence where the failure of one major bank could trigger margin calls and collateral demands that destabilize dozens of others. The CDS market prices this systemic interconnection. Equity markets do not. The second thing most people miss is the incentive structure around disclosure. Banks are not required to report real-time asset valuations, loan performance, or derivative mark-to-market losses. Quarterly filings are released 45-60 days after the quarter ends. And even those filings contain discretion in how certain assets are valued and how reserves are calculated. A bank experiencing deteriorating asset quality in December will not report it publicly until February at the earliest. But the bank's counterparties, other banks and institutional lenders, see this deterioration in real time through payment flows, collateral calls, and credit line draws. They respond by hedging, which widens CDS spreads, which signals to other market participants that something is wrong, even though the public has no access to the underlying data. Regulatory bodies face similar incentive problems, acknowledging banking sector stress risks, triggering the very panic regulators seek to avoid. Central banks and financial stability authorities will not publicly confirm elevated risk until it has already been reflected in market prices and deposit flows. By that time, the cost of hedging has become prohibitive and the opportunity to reposition has passed. The institutions with the foresight to act early benefit. The public, relying on official reassurance, does not. The third thing most people miss is the feedback loop between CDS spreads and funding costs. When a bank's CDS spreads widen, other banks and money market funds perceive higher risk and demand higher yields to lend to that institution. Higher funding costs compress net interest margins, reducing profitability and weakening capital ratios. Weaker capital ratios justify wider CDS spreads. This loop operates independently of loan performance or asset quality. A bank can be fundamentally sound but still face a funding crisis if market perception shifts. This is why bank runs happen, not because depositors have detailed knowledge of asset valuations, but because they observe signals like widening CDS spreads and conclude that others know something they don't. Finally, most people miss the political economy of bank rescues. In 2008, the government committed $700 billion in taxpayer funds to stabilize the banking system. In 2023, the Federal Reserve created emergency lending facilities within 72 hours of SVB's failure. These interventions were possible because the crises were acute and visible, creating political consensus for action. But if the next crisis unfolds more gradually, or if political conditions make large-scale intervention unpopular, the playbook may not be repeatable. The CDS market is pricing in this uncertainty. It is pricing in the possibility that the next distressed bank may not be rescued, or may be rescued only after significant losses are imposed on creditors. This is not speculation. This is institutions acting on the assumption that the implicit government guarantee for systemically important banks may be weaker than it was in previous cycles. Bank credit stress does not manifest suddenly. It builds gradually through deteriorating asset quality, rising funding costs, and declining confidence until a threshold is crossed and the system destabilizes rapidly. What we are observing in the bank CDS market is the early stage deterioration, the phase where sophisticated institutions hedge exposure before the deterioration becomes public knowledge. Historically, when bank CDS spreads cross 80 basis points and continue widening, the first casualty is interbank lending. Banks become unwilling to lend to each other overnight, even at elevated rates, because the risk of counterparty failure is perceived as greater than the interest income earned. This breakdown in interbank trust forces banks to rely on central bank facilities for liquidity, which is more expensive and carries reputational stigma. The shift from private to public funding is a warning sign that market-based liquidity is exhausted. The second thing that breaks is access to wholesale funding. Money market funds, corporate treasurers, and institutional cash managers become unwilling to hold bank commercial paper or certificates of deposit. These instruments represent trillions of dollars in short-term funding that banks rely on to finance operations. When this funding disappears, banks are forced to shrink balance sheets by selling assets or calling in loans. Both actions are contractionary. Businesses lose access to credit lines. Commercial real estate loans are not refinanced. Consumer credit tightens. The economic impact occurs before any bank has actually failed. The third thing that breaks is confidence in deposit insurance. In the United States, the FDIC insures deposits up to $250,000 per account, but total insured deposits across the banking system exceed $10 trillion, while the FDIC's Deposit Insurance Fund holds approximately $128 billion. That represents 1.27% coverage. The system relies on the assumption that not all banks will fail simultaneously. If confidence erodes and depositors begin moving funds from smaller or weaker banks to larger or stronger banks, or out of banks entirely into treasury bills or money market funds, the resulting deposit outflows force asset liquidation, which validates the original fear, which accelerates the outflows. This is not a hypothetical. This is precisely what happened in March 2023. The broader implication is that the banking system operates on trust, and trust is fragile. The cost of hedging bank counterparty risk is a real-time measure of trust. When that cost surges 340% in 6 months, as it has for certain institutions, it signals that trust is eroding at a rate that historically precedes systemic events. The specific trigger, whether it is a commercial real estate default, a derivative blowup, a foreign exchange crisis, or something entirely unforeseen, matters less than the fact that the system has become vulnerable. The chart forced banks to hedge because their internal risk models indicated that the probability of loss had crossed thresholds where hedging became mandatory, regardless of cost. This is not a prediction of imminent collapse. This is a documentation of the mechanical process by which resilience erodes before failure occurs. The institutions with visibility into counterparty risk, asset quality, and derivative exposure are acting as if that erosion is already underway. The chart did not create the risk. The chart revealed that institutions with trillions of dollars at stake have already concluded that the cost of trusting other banks has become unacceptably high. The hedges have been placed, the premiums have been paid, the signal is complete. What happens next depends on variables that cannot be forecasted. The trajectory of asset prices, the willingness of central banks to intervene, the behavior of depositors, and the capacity of governments to act decisively. But the pattern is established. When bank CDS spreads widen at this velocity, in this magnitude, without public catalyst, it has historically preceded disruption within quarters, not years. The institutions that hedged early in 2007 survived. Those that waited for confirmation did not. The institutions that hedged in early March 2023 protected their capital. Those that waited for regulatory disclosure faced losses. The current cohort hedging at 89 basis points is not speculating. They are responding to information asymmetries that exist between those who manage risk for a living and those who rely on public disclosures to understand it. You will not see this discussed in earnings calls or regulatory press releases. You will not hear it acknowledged until the event it signals has already occurred. You will only see it in the data, the spreads, the volumes, the velocity of change. And by the time it reaches the financial press as a headline, the repricing will be complete and the opportunity to act will have passed. The chart forced their hand. The question is whether you understand what that means before the rest of the market does. This is the collapse files. The data does not predict. It documents what has already begun.